Greetings, Single Point friends and clients. This is Rene, CIO at Single Point. Just wanted to send a quick message out. This morning we woke up to a continuation of the market sell-off that began last week. The last time I checked, the S&P was down another 2.5% today. What does that mean? That means that for year to date, we're looking at a technical correction. Technical correction is 10% from the peak. So the S&P is down just under 10%. It was actually down over 10% a little bit earlier this morning. It's come up just a little bit. The Nasdaq, which is the tech-heavy sub-index, that's firmly in correction territory. It's down 14% from the beginning of the year. And I just wanted to note this: the blue line up at the top, that's down 1.5, plots the price of the bond index. So again, bonds are playing their historical role of maintaining their value, maintaining stability in the face of a sell-off and a correction on the equity side. So a couple questions we've been fielding. What's the trigger? The trigger for this really is threefold. Number one, there's obviously been a lot of headlines around the Fed beginning to raise rates and normalizing interest rates after a long period of effectively 0% interest rates. And this is a normal reaction. Every time the Fed over the last 40, 50 years has signaled that they're going to raise rates, it typically leads more often than not to a pullback in the market. Nothing epic, but certainly 10%, 15% correction from the recent peak, entirely normal and expected as the market digests the idea of higher interest rates. That is not a reflection that we're going into a recession. It is simply a reflection that money will be more expensive to borrow and that there will be more attractive alternatives to invest cash, right? Since bonds will now have a higher yield. So that's one factor that's weighing on the market. A second factor is simply that, especially in the tech sector, there's been a lot of speculation. There's been a lot of hot money that has flowed into some of these hot tech stocks, and a lot of that sentiment has now shifted. And this is the reason why this orange line, again, the tech-heavy index, is down more than the S&P 500 that covers a much broader array of sectors, right? So certainly we're seeing profit taking. That's also driving some of the sell-off. And, you have a situation now where folks want to, trim their positions, and there's not enough buyers on the other side. So you get this dynamic here with prices reflecting, this drop. The final thing I wanted to mention that I believe is also weighing on the market is the situation in the Ukraine. And I think some of those headlines are worrisome. Some people would even say they're scary. The idea of even a small risk, but a risk of a hot war with Russia. Certainly something that the market is digesting and that is giving a lot of potential buyers pause until there's a little more clarity on how this thing gets resolved. So that's certainly weighing on the market as well. I think the most important message that I want to leave you with is that I think this graph very clearly illustrates why we stress the importance of bond and cash buffers, right? Once again, the bond aspect of client portfolios is holding its value very well, even as the equity side goes through its normal corrections, right? As painful as they are, these are normal and they're part and parcel of long-term equity investing. And from our perspective, again, we have a playbook, right? We lived through an even worse correction at the beginning of the pandemic. And let me pull up that chart right here. It was about a 35% drop from the high about in late February before the news of the COVID hit. And then to the bottom of the market, which was in late March, it was about a 35% drop. And our advice then was to stay the course, rebalance back to our established targets, tax loss harvest when appropriate to bank tax losses for future years' gains. And that remains the playbook and the best practice